Hey, what's up, stock compounders? Brad here. So, Mohnish Pabrai delivered his guest lecture at Boston College earlier this month, October 2020. And as always, he did not disappoint. So, I wanted to share my highlights from this 2+ hour talk that he gave at Boston College. And of course, I will link in the description to the full video. Highly recommend it. There's a lot of great stuff in here. But just wanted to share my highlights. So let's go through that. The first point he made is the best way to learn is to teach. That's a big reason he does these couple of talks each year at universities around the world. And of course, I have found that to be the case as well, which is a big part of why I have this YouTube channel. I really want to kind of gain mastery in the realm of investing. And so, in order to teach all of these aspects of investing to you guys, I have to, really kind of dig deep and make sure that I know what I'm going to teach. So there's a deeper level of preparation that's involved with teaching. Now, in the beginning of Pabrai's talk, so for like the first half hour, he showed a few slides and kind of talked through them. And then the last hour and a half was the Q&A. So I just want to share a few things about the first half hour with the slides that he presented. So he showed the last 125 years basically of the Dow. What did the Dow do over the last 125 years? And it's really interesting. You can see, there's these decade to 2 decade long periods of pretty impressive growth. And they're usually followed by a decade or two of time that it takes to get back to that kind of peak from the last growth phase. So you've got this growth phase, you've got a drop, and then a phase where the market is climbing back up to get to the previous peak. And so even though the S&P, I talk about the Dow, but he also showed a chart for the S&P. The S&P returned 9% per year on average, but average over the last 100 years. But the average, it doesn't tell the full story. Okay, the bigger story is that there's these periods of stagnation, followed by periods of pretty strong growth in the stock market. Pabrai seems to think that speaks pretty heavily to human psychology, right? He says, in general, the human memory does not go past 17 years, okay? What was interesting is 17 years seem to be kind of on average how long these boom and bust cycles last. So that's interesting. And of course, the boom and bust cycles are a natural product of human psychology, right? You've got these periods fueled by greed where, in the recent past, the market has done really well, climbed. And so people pile in, more and more people pile in, thinking, this thing's never going to end. So I need to get mine. And that's how the market becomes overvalued, quite significantly overvalued. And then things come crashing back down to earth, to the point where things get significantly undervalued. So you've got these very emotional swings in the market that are driven by fear and greed. Pabrai he talked about his first 5 years of investing, which was 1995 to 2000. And it just so happened that those first 5 years of investing for Pabrai were the end of a very strong boom cycle, right? Of course, the NASDAQ just went gangbusters towards the end of the 1990s. And, his approach then in those first 5 years were, okay, I want to find companies with long runways. And I want to buy those companies and I want to put them in the desk and I don't want to look at them again for 2 or 3 decades, okay? That was his plan in the beginning. Now, as it so happened, two of the companies he bought were 100 baggers. They really benefited from the tailwinds of the tech boom. And he was able to sell those pretty close to the peak, which is really impressive to me. But then over the next, from 1999 to 2011, the market was quite flat, okay? And his approach changed. So, he sensed that the market was going to be pretty flat. And so he switched from buying these long-term compounders and doing nothing, just letting them, compound his portfolio. And he switched to the approach of buying $1 for 50 cents, buying these companies, where he could pay 50 cents today and get $1 back in 2 or 3 years. That's really the approach that he used from 2000 all the way through to just like last year. Okay, so 19 years he was trying to buy $1 for 50 cents. And of course, buying $1 for 50 cents, is not very tax efficient, because it's much more efficient tax-wise to buy something and let it ride for decades than to get in and out of these positions every couple of years. It's also a lot more work to have to find these dollars for 50 cents, every maybe a couple each year. It's a lot more work. So the focus shifted from buying great long-term businesses and putting them away in the coffee can to buying $1 for 50 cents. There's two very different frameworks for two different market conditions. And he mentioned Korea, which I did a video about a few days ago. He says Korea is quite a cheap market at the moment. It's a place I'm interested and excited to invest in. So if you're interested in the Korean market, check that video out from a few days ago. And then he mentioned a quote from Charlie Munger. Charlie Munger says there is no intellectual way to defend this, but Charlie does not sell businesses he owns when they get above intrinsic value. Okay? He won't buy them above intrinsic value, but he also won't sell them if they are somewhat above intrinsic value. He might look at it if it's egregiously above intrinsic value. So that's very different from the way that Pabrai was conducting business, right? Buying at 50 cents, selling at 90 cents, maybe selling at $1, looking for doubles every 2 or 3 years. That is not the approach that his mentor, Charlie Munger, was taking. Pabrai really wishes he had changed his approach 2 or 3 years ago. He said that earlier this month. He wishes he would have seen that we're in a different kind of cycle. We're in a different phase of the stock market. We're in this kind of market-wide growth phase versus, that market stagnation period. But he talks about how over the last, from 2000 to 2015, 2016, his approach of buying $1 for 50 cents has worked really well. So he's very happy with those results. But it's very interesting that he's talking about how he thinks we're in kind of a different paradigm now, where there's more gains to be made by trying to identify these long-term compounders, great businesses that have a defensible moat, and just parking the money there rather than getting in and out of things. Right, so he's operated in a very linear fashion over the last 2 decades, in and out of different companies. We're back in the compound growth phase of the market. He thinks this current party will end in the late 2020s or the early 2030s. So that's interesting. That's a fairly specific time frame for a party that started somewhere around. I think by the metrics he was showing in the graphs, 2016 was kind of when the party started that we're currently in. So he's thinking, somewhere around 15 years we're going to have an overall bull run in the U.S. stock market. So it's interesting that he would say something like that. I don't think of him as thinking in that kind of way, in kind of a macro picture way like that. But, he seems to be fairly confident that, we've seen those patterns throughout the last 125 years in the U.S. And then that pattern, fairly closely will replicate itself moving forward. He talks about how markets swing from extreme undervaluation to extreme overvaluation. I already kind of talked about that back and forth. And that's something that's going to continue. There's a lot of people who think, well, investors, we have access to all of these tools that we didn't have access to before, so we're going to be more rational moving forward. But, people don't invest mechanically. We invest as humans. We invest as emotional humans. And it's hard to see that changing, even with the access that we have to technology to try to, rise above that. It's just not, at the end of the day, it's humans that are driving these investment decisions. Right, so what he learned in 2020, focus on the compounders. One of the issues with Pabrai is he's too cheap to pay up for great businesses that are going to be long-term compounders. But that's okay. If it's too expensive for him, even though he knows it's a great business, he's just going to pass. Because there's 50,000 public companies to choose from around the world. And there are always going to be stocks from time to time that are both great long-term compounders and cheap. So that's all Pabrai needs to focus on, is to find those businesses where he can satisfy, his bargain desires and get these great businesses that are going to be great for a long time. He really only needs to find one per year in order to, make the machine work, make the compound growth engine continue to spin, continue to hockey stick upward, one a year. So, there's nothing groundbreaking there. He's no longer looking for those 50-cent dollar bills. We're in a different Pabrai mindset right now. Long runways at reasonable prices with a lot of stability. That's the game. Okay, so now we're in the Q&A session. So he was asked, what are, have you had failures? What have you learned? What have been your biggest failures? So he says failures are part of investing. Anyone who's investing is going to have failures. Because what we're doing in investing is we're trying to extrapolate deep into the future, right? Which is inherently a very inexact game to be playing. It's not possible to be accurate about where a company is going to be 15 years from now, let alone all 10 companies that you might have in your portfolio. It just doesn't happen. So you have to be okay with failure, and you really have to learn from failure. That's the hallmark of the best investors. And the biggest mistake that he's made is buying companies with too much leverage. Too much leverage is the biggest reason for failure in both Pabrai's portfolio, looking back over the last 25 years that he's been investing, and he conducted a study of great investors and what investments went wrong throughout their investing lifetimes. And the biggest reasons that investments fail is there's too much leverage. So that's something I've really taken to heart. It's definitely one of the first things I look for in an investment. How does the debt compare to cash, compared to operating income? I want to make sure it's not out of line with what the business, the earnings that the business is generating. Question 2, when valuing a company, what are the most important criteria or metrics? And of course, it depends on the business. There's different yardsticks for different companies. He talked about 3 different companies and kind of what the different yardsticks are for those companies. He talks about Maotai, which is an alcohol producer in China. He talked about how each bottle costs $3 to $4 to make and sells for hundreds of dollars. So that's a fantastic business right there. Those are phenomenal financials. He talked about Fiat Chrysler and how, when he initially looked to create Fiat Chrysler, they were generating $130 billion in annual revenue with a $5 billion market cap. So, he figured if Marchionni was able to, even slightly right the ship and turn Fiat Chrysler around, it was going to be a 5 to 6x in as many years for Fiat Chrysler, and that's really how it played out. And then he talks about NVR, which is a U.S. home builder. So take a look at that part of his talk for sure. That's really interesting to hear about, the different metrics that he, looks for in different companies. You really need to get to the factors that matter. If you can understand the 2 or 3 variables that will drive the outcome of that investment, that's really all you need to do as an investor. But you have to understand the business in order to do that. There's no shortcuts for that. Question 3. So he was asked about retail, what he thinks of retail. Pabrai has never liked retail, and there's a number of reasons for that. The problem with traditional retail is that it's the most transparent of businesses. Okay, so Sam Walton, who founded Walmart, spent an enormous amount of time in his competitors' stores, right? And he would just copy everything that was working really well in his competitors' stores. There aren't any trade secrets in retail. Everything is, right there for everyone to see. So it's really difficult to have a moat, to have a competitive advantage in retail. And one of the most important things in business to Pabrai is recurring revenue streams, right? And retail, most retail doesn't have that. You've got to rely on your customers to come in, a couple times a year and buy new clothes. But it's very easy for those customers to go into a different store. There's not a lot of stickiness with retail. Of course, that's Costco, Amazon have figured out some ways to create more stickiness, to create these recurring revenue streams. Of course, you have Amazon Prime, which is a recurring revenue stream. You've got Costco, you have to have a membership to Costco. That's a recurring revenue stream. So there's some retail, that do have that competitive advantage. But that's okay. Pabrai, he doesn't look at retail. He throws everything out in the retail sector. Is he going to throw out some gems? Yes. But, like he likes to say, like Buffett likes to say, there's no called strikes on Wall Street. It's fine if he's throwing out a few of these great retail companies. It's not a problem. And then he talked about Berkshire Hathaway and how Warren Buffett, his track record investing in banks is phenomenal, right? I think he's got 1,000, batting average with banks. But if you look at the retail investments that Berkshire Hathaway has done over the years, most of them have been duds. Most of them have basically been failures. So it's really hard. It's really hard to do well investing in retail. And so Pabrai, just tossed that sector out. Question 4, where do you start when it comes to finding new investment opportunities? So, of course, Pabrai, as a shameless cloner, look at what other great investors have bought. He mentioned Chuck Akre, David Tepper, Jeffrey Ubben. Just go to Dataroma, every 3 months when all the 13 Fs come out, and see what these great investors have bought recently. And then see if you can reverse engineer what those investors are seeing in those companies that make them compelling investments. So yeah, right, there's 50,000 stocks globally that we have to choose from. if you only look at what other great investors have bought recently, you're dramatically narrowing down that field of 50,000 to something much more manageable. And then, you take that narrowed down field, that your clone basket, and you throw out industries that you don't understand. Retail for Pabrai, financials, pharmaceuticals, healthcare, all gone. It's as quick as that. And then you go deep on the few that you understand, the few that rise to the top, that fit into your circle of competence, that you're interested in. Those are the few you go deep into. Question 5, how do you approach international stocks? So this is something I've been thinking about recently. I've been looking at what Pabrai is buying in Korea. So Pabrai's approach to this, because there tends to be less rigorous kind of governance of companies internationally, especially in developing countries, emerging countries. He likes to visit the company. He likes to kick the tires. He likes to meet management, because there's a much higher risk of fraud when you go out of the U.S. or out of kind of the developed countries. So it's important that you do more due diligence because of that. It's more work, but it's work that Pabrai enjoys doing. And the tailwinds can be much stronger in some of these emerging companies, emerging geographies, emerging countries. He thinks there's some massive tailwinds happening in South Korea and India. That's why he's doing a lot of hunting there. Question 6, how have you managed your portfolio during this pandemic? So he says, during the best of times, even the best of times, most businesses are fragile. Capitalism is brutal. There's always competitors coming in to steal market share away from you, to copy your ideas, to knock you off the pedestal. He took a good hard look at his portfolio back in March when this pandemic was getting underway in the U.S. And he got particularly concerned about Fiat Chrysler, right? Because it has so much operating leverage. When Fiat Chrysler has to shut down a plant because to prevent this disease from spreading, that is a lot of cash that they're burning to not be producing any cars from that plant. There's a lot of overhead. He decided to get out of Fiat Chrysler back in March, completely out. He thinks the pandemic is going to last a while longer, until people can show that they're vaccinated. He thinks there's going to be some kind of, certification, some kind of, proof that you've been vaccinated before, travel really starts to open up. So it's going to take some time. He didn't mention exactly how much time, perhaps until the middle of next year, summer of 2021. That's kind of my sense about how long business is going to be impaired. People aren't going to be going out as much until there's a widespread vaccine. There's still a lot of fear, and there's still case numbers that are growing, so the fear is justified. He made 2 great investments near the end of March. So at the same time that he was having to sell Fiat Chrysler because there's this real concern that's going to be impaired, these great opportunities are popping up. So he's very happy with those 2 investments that he made in March. And then he was also asked, do you think value investing is dead? How do you think of growth investing versus value investing? And he said, I really like this answer. Growth and value are attached at the hip, all right? Growth is an aspect of valuing a business, right? In order to value a business, you're taking the future cash flows, you're estimating the future cash flows, you're discounting them back to today, and that's what the business is worth today. That's the value of the business. So for growth companies, you just have more growth that you have to factor into your calculations of future cash flows. So there's no difference between growth investing and value investing. And if Pabrai had to choose, he would love to invest in companies that are growing quickly, right? Those are the great long-term compounders. So I like that answer. He said, if you make 8 to 10 bets on companies that you are convinced have long runways, right? You can be wrong 40% of the time. So if you buy 10, you can be wrong on 4 of them and still become very wealthy, okay? So there's it's a very powerful thing to play this game of finding long-term compounders and, finding 8 to 10 great companies. This is really how Pabrai started his investing career. He spent like a year studying Buffett. He bought, it turned out he bought 14 companies. 9 of them he put 100,000 each into. And then he had this little basket in India where he bought 4 companies with like $30,000. And two of those turned out to be 100 baggers because of the tech boom, right? The tech bubble. So, you can do very well approaching it that way. Investing is a game of opportunity cost. He gets a little cheeky here. The mistress always looks better than the wife, okay? So he's talking about if, say you have an investment and another one comes along, how do you decide if you sell the one you have to buy this other one that maybe looks a little bit more attractive, right? And the point he's making here is that everything we know very well, so a business we own, we're probably going to know better than a business that we don't own, right? And everything that we know well, we also know all of the blemishes, right? So the investments we hold, we know the potential issues with those. We know there's some hair on them. And because of this inherently human nature of being greedy, when a new investment opportunity comes along, we look at it and we want it to be a great investment opportunity, right? So we look at it through a lens of like, oh man, this could be something special. And so there's something in our wiring that makes us want to ignore the potential issues with it. And that's the mistress analogy. Your wife, your wife really well. There's challenges there, right? There's always challenges. And the mistress, all you know is the mistress looks great, right? She's hot. You don't know the issues underneath. So that was an interesting analogy. So one thing Guy Spear does to help him with this issue of, kind of wanting to be quick to bail on companies we own, to buy the company that looks sexy on the surface, is Guy Spear makes the switch hurdle very high. So it can't be, all right, I think this one is maybe an 8 out of 10, and maybe this one's a 9 out of 10, right? The one I own is 8, the one I want, the one I'm looking at is 9. That's not a high enough switch hurdle. The one, for Guy Spear to sell a company to buy another one, there's got to be a dramatic difference in what he thinks those two businesses are going to do over the long term. And, I think there's some wisdom in that. Next, humans are bad at cloning and copying. There's something, I think Pabrai thinks there's something beneath. Humans don't like to copy. They think it's beneath them to copy other people's ideas. And, I think we learn a lot of that in school growing up. It's unethical to copy your neighbor, right, on a test or a quiz or even homework a lot of the time. And we learn that it's amoral. There's something wrong about copying other people's work. And that's not true in business. It's not true in investing a lot of the time. Obviously, there's copyrights, there's things, it is amoral to copy But there's a lot that, that's just part of being a great investor, is copying certain aspects of what other people are doing. And most of Pabrai's investments he got from other great investors, and that's just an efficient, intelligent way to invest, to conduct the affairs of investing. Because of this, because humans are bad at cloning and copying, because there's something in our wiring that prevents us from doing that, there's opportunities for those who are willing to engage in that behavior. And that's it's a critical element of improving your performance as an investor, being willing to copy, willing to clone, willing to get great ideas from other investors. It doesn't mean you blindly buy, right? Maybe you do. Maybe you have a system for that, a thoughtful system for doing that. But because we can see what these great investors are buying and selling, it's dumb to not take advantage of doing that. So that's the point I'm trying to make. He was asked about his investment checklist. The purpose of the investment checklist is to identify holes in the analysis, right? Like I said, when we're confronted with a new investment opportunity, we want to find why it's going to be a great investment. Obviously, right? We want to get rich. We're driven by greed, right? So we want this thing to be an awesome opportunity. It's easy to be enamored by these shiny new investment opportunities. So the checklist, Pabrai has a checklist. It's like 160 questions. And it's like, all right, have I looked at this potential investment opportunity from every angle, right? And, usually Pabrai, after he thinks he's done everything he needs to do with a new investment opportunity, there's 10 or so questions that he doesn't know the answer to on his checklist. So he has to go back to work and find the answers to those 10 questions. And sometimes those reveal blind spots that, he no longer wants to invest in that company now because it's too big of a red flag that was turned up because of the investment checklist. So really valuable thing, that checklist. Hopefully someday he shares it. I'm not holding my breath, but I know there's a great book out there called what is it called? I think it's just called The Investment Checklist or the Checklist Manifesto, something like that. Let me know in the comments if you've read that one. He was asked, how do you find ideas, right? There's 50,000 stocks globally. How do you kind of narrow down to find the ideas? Well, I kind of already answered that, but he goes a little bit further there. He says, look at Value Investors Club. Read these write-ups that great investors have written about companies. There's usually 1 to 3 new write-ups each day that come out on Value Investors Club. So read those. Learn to see businesses through the eyes of thoughtful, intelligent investor. Like we mentioned, data Roma. Look at what great investors are buying. Try to reverse engineer why they bought it. That can be a really fun exercise. Keep poking around, right? Use all of the resources that we have available. In a lot of videos I've made in the past talk about different resources. Corner of Berkshire and Fairfax is an awesome resource. I actually got that one from Mohnish Pabrai. There's within that, it's a message board. There's an investment ideas kind of message board. You can go look through, what really smart investors in Corner of Berkshire and Fairfax are buying. You can read, the dialogue that they have going back and forth, kind of challenging each other on whether or not these are, in fact, good investment opportunities. And once in a while, you get hit on the head with a 2x4, right? An investment idea comes along that's within your circle of competence that you have to scratch your head like, is this real? This seems too good to be true. And once in a while, you get an opportunity that is too good to be true. but it's true, right? And those are the ones you want to seize and bet big on. Students, every lecture that Pabrai does, he gets asked about the Kelly Criterion, which is in the Dando Investor, the book, one of the probably the best book that Mohnish Pabrai has written. He has a chapter on the Kelly Criterion. It does not apply to investing. Every lecture, Pabrai gets a question about it, and he says, if I could rewrite the book today, I would have excluded that chapter. I would not have mentioned the Kelly Criterion. So please, Arvind, please, professors of these classes who are inviting Pabrai, tell your students to watch at least one past lecture and stop asking Pabrai about the Kelly Criterion. It's painful. He's such a smart investor. We need to use every question thoughtfully to really get as much as we can out of this brilliant investor. All right, enough. I'm going to step off my soapbox. He was asked about circle of competence. How important is it to have a big circle of competence? It really doesn't matter how big your circle of competence is. The important thing is that you know where the edges are and that you stay within your circle of competence. And he gives the example of, I think it's one of Charlie Munger's friends, this real estate developer in Palo Alto. And this guy, all he knows is, I believe it's commercial real estate within a couple miles of the Stanford campus. That is all he knows, okay? And he's, I think he's a billionaire, right? So you don't need a huge circle of competence. You don't have to understand 10 different industries, right, to do well as an investor. You have to know where the edges are. You have to stay within your circle of competence. And the closer to the middle of your circle of competence you can stay, the better you're going to do. And he gave a tip about, if you're just getting started with investing, how do you know where your circle of competence is? Start with businesses that make things that you use, that make things that you buy. Phil Town talks about this as well. Phil Town owns Ruger, which is a gun manufacturer. Phil Town, owns guns. He's a gun guy. He researches companies within, he used to be a river guide, so he knows outerwear, he knows camping gear. So, think about the kinds of businesses that you buy from, right? And start with those. You understand those products, which is going to help you understand the business. He's asked about how do you evaluate management? How do you decide if a CEO or a management team has what it takes? And he says the way to judge a leader is not to focus on what they say. That's what a lot of people do. You listen to the recent earnings calls, you watch YouTube videos of these CEOs talking, but it's really, that's not the important thing, what they say. The important thing is what they've done, right? And how does what they've done match up with what they're saying? Are they owning up for their mistakes? Look at their track record. And that's an advantage that we have as public company investors over, private company investors, is that a lot of these public companies have management with a fairly long track record. We can actually look at what they've done over the years, what they've accomplished, to evaluate how they're going to do moving forward. And he mentioned Elon Musk, which was interesting. He thinks Elon Musk is leaps and bounds ahead of any other car company CEO. He's very impressed by Elon Musk. But of course, he's not going to touch Tesla at its current valuation. But he also says he would never bet against Elon Musk. I mean, how can you bet against a guy who has simultaneously landed 2 rockets, right? What he's doing with SpaceX, what he's doing with multiple businesses. It's pretty incredible. So that was interesting to hear him have those kind words to say about Elon. And then, he was just asked any advice to the students who are graduating into this environment, right? We're in the midst of this pandemic. It's a really uncertain, scary time to be graduating from college, entering the job market. So what would Pabrai's advice be? And he said this before, he's very consistent on this point. Given the safety nets in our society, it's very unlikely for anyone who's graduating college to be homeless, to be hungry. Like, we have safety nets in our society. And he really recommends focusing on pursuit of passion. Go after what you're excited about, okay? And I really like that message. And it's a really difficult one to follow because, put yourself in the position of someone graduating, a prestigious college, right? Like Boston College, Harvard, any of these prestigious universities. We're so influenced by our peer group, right? We want to be highly regarded by our peers. So, and there's opportunity costs as well. When you're coming out of college, there's companies that are willing to pay you X amount, right? Because of your education, because of your degree. So, when you're deciding, okay, am I going to go out on my own and start this business or pursue this passion? I'd be giving up, this more certain future of earning, however much per year. I'd be giving that up. So it's a really difficult thing emotionally, but it's the best time to do it, right when you graduate, because you don't have a family usually, you don't have kids, you don't have a wife. If you fail, if you fall on your face, the repercussions are much smaller. They're much smaller than they would be if you have dependents, if you have a wife, if you own a home. The potential downsides are much less if you're doing it right out of the gate, right out of college. So that's what Pabrai did, right? He started a business using credit cards, like $70,000 in credit cards and $30,000 from his 401k, and started a business. And he knew if it didn't work, he wouldn't be able to pay back the debt. He would declare bankruptcy. He would start over. He would just go back to his old job. So the downside was very minimal. And that's really what Pabrai is all about. Heads I win, tails I don't lose much. How do I take opportunities where the downsides are very muted? The downsides are limited. That's the whole game in investing, in entrepreneurship. So I really like that message for graduates who are coming into the job market at this time in 2020. So that's all I got, guys. Fantastic talk from Pabrai. Check it out if you haven't heard it yet. And I thought this was interesting. See what's being recommended by Google, by YouTube. YouTube knows me well. You've got my buddy Investing with Tom, investing lessons that will work forever. The Intelligent Investor. I love it. And then you've got Charlie Munger here and Lee Lu. So kudos to YouTube for spying on me, for understanding who I am and what content to serve up next. That's awesome. But with that aside, thanks for watching, guys. Check out Pabrai's talk, and I will see you guys in the next video. Take care.